Very good morning, friends. So, today I'm going to take with you Accounting Standard 29. And I think before I begin, let me also give you a little brief introduction of myself. I'm a chartered accountant. Of course, I think I've used that prefix in front of my name. And I have been in the teaching field for almost more than 20 years. I qualified way back in 1999 and I've been in teaching since then. And my area of specialization, of course, is accounting. And I have been teaching CA Intermediate Accounting, Advanced Accounting, and I teach at the CFN level financial reporting as well. I've also authored books on all these subjects, whether it's intermediate accounting or at the final level. So, intermediate accounting, advanced accounting, as well as financial reporting, which are printed and published by McGraw-Hill as well as Taxman. So, today I'm going to begin with you another interesting accounting standard, and that is AS 29. Now, as I said earlier also, and I'm going to say that today also, that when you look at an accounting standard, you should always first give a first look to the name of the accounting standard. And if you notice in the name of AS29, we can clearly see that there are a total of three agenda. I can see the word provisions, after which there is a comma, and then there is a contingent liability, and then there is an explicit word and it says contingent asset. So one thing is pretty clear that AS29 is dealing with a total of three issues. One is provision, one is contingent liability, and one is contingent assets. Technically speaking, it is not possible to discuss provisions on a standalone basis and contingent liability on a standalone basis. Well, we can discuss contingent assets on a standalone basis, but some way or the other we need to discuss provisions and contingent liabilities together. But I guess for the time being, as I'm going to start my discussion, I am not bringing that contingent liabilities into account. But there is a huge connect in terms of provisions and contingent liability. By the way, do you like maths? No, sir. So, but why are you asking you like maths or not? Well, I have a hidden agenda because I'm going to do some basic maths today with you. So, but what is AS29 got to do with mathematics? Well, it's nothing got to do with mathematics, but I am going to use some simple plus, not even minus, some simple additions in terms of mathematics in order to understand the concept of provision. Now, let me first of all, I think, go to the definition of what is a provision. And I'm going to read that definition and we're going to create some concept on that basis. And I'm also going to make a run through with some good examples with you on this. And trust me, today you're going to get a good hang in terms of how do you decide whether it is a case of creating a provision in the books of accounts or not. Let's, I think, read the definition. It says a provision is a liability. It says a provision is a liability. So why did you stop at the word liability? One misconception what people have got is that when you say a provision, there are two kinds of provision. One is a provision which is created against asset, and one is a provision which is a provision for a liability. AS29 does not deal with any provision against an asset. So if you're thinking in terms of provision for depreciation, for example, you apply accounting standard 10. So if you're thinking in terms of AS29, remember it is a provision which is a provision is supposed to be a liability. It says which can be measured only by using a substantial degree of estimation. Estimations are required when there is uncertainty. You need an estimation when you know that there are things which are uncertain. Now this provision for a liability is relating to, you can say, something which is related to the future. So when you say it relates to the future, you would need a estimation. And he's very clearly saying in the definition, substantial degree of estimation. There is a small little example which comes to my mind to elaborate the concept of this definition. So before I take you further, I would just like to bring you to a small little example to give you a little clarity of thought. Let's say, for example, this is my financial year that is 1st April 19 and is ending on March 20. Let's say I get my electricity bill and that is received once every 2 months. So let's say the last electricity bill came, let's say, in February. So you're going to get the next electricity bill after 2 months, which means you're going to get this in April, right? So I got my electricity bill in the month of February. Since it's a cycle that you get the bill every 2 months, the next bill is going to come in April. Now the question rises, when you're going to make the balance sheet on 31st March, do you think I should provide for the bill of March in the books of accounts? Should I make a provision for the March bill in the books of accounts? And you would say, yes, sir. We should make a provision for the same. Now, the question rises, if you say, yes, I should make a provision, is this going to be covered under Accounting Standard 29? When you're going to say that I need to make a provision for the month of March in the books of accounts, is this a provision under the definition of AS 29? And the answer is a no. The answer is no. In this case, I will make a provision, but this provision is technically not a provision. It is an accrual, not a provision. Let me first of all emphasize something very important. In my given example, you are looking at an expenditure which has already taken place. You're looking at an expenditure which has already taken place. And in this particular case, since the expenditure has already taken place, it can never be a case of provision. Remember, provision is always for a future expenditure. So one of the key things which you need to keep in mind is that when you're looking at the concept of provision, you are looking at a future expenditure. And future expenditure always needs an estimation because future has to be predicted and prediction has to be on the basis of estimation. So remember one very important thing, that when you're looking at a provision, you're looking at a liability for a future expenditure. So which means you are trying to make an estimation that when you are going to settle this liability in the future, then what is the estimated outflow in order to settle the obligation? Mind the words. So in this particular case, when you provide for, let's say, any accrual of expenses, you might need an estimation as well. But the level of estimation required for accrual is much less as compared to estimation required for a provision. And that's the reason that Accounting Standard 29 says substantial degree of estimation. Substantial means huge. So I think let me come back to the definition and give you a little mathematical input. If I look at the definition of provision, it says it's a liability, focus 1, which can be measured only by using a substantial degree of estimation, focus 2. So can I mathematically say that provision is liability plus estimation? Isn't that makes life simple? That if somebody says that is it a case of provision, tell him, ask the question number 1. Is it a liability? Yes, sir. Go to the next question. Does it need a substantial degree of estimation? Yes, sir. Then it is a case of provision. And a degree of estimation being substantial relates only when it is future expenditure. Okay, but then the next question which comes to the mind is, what is a liability? And liability is given below the definition again in para number 10.2. Liability is a present obligation of the enterprise arising from past events. the settlement of which is expected to result in outflow from the enterprise of resources embodying economic benefits. Oh my God, the definition seems to be very technical indeed. We are not supposed to remember definitions, but we are supposed to know the larger concept. So, when I am looking at the definition of liability, there is another mathematical equation going at the back of my mind. Don't worry, the notes will be given to you later. We need to first develop a strategy in terms of concept, apply that concept to given problems and get the answer. So, I am looking at liability also with a mathematical equation. Liability is a present obligation arising from past events. Focus 1. The settlement of which is expected to result in outflow. Focus number 2. So I would put a mathematical equation that liability is a present obligation, of course, arising from past events, plus outflow. So you said two equation. I think let me do one thing. I think, first of all, take you to a little mathematical equation. Now see this very carefully. We are trying to develop a three-step procedure. Oh. So accounting standard 4, you had a three-step procedure. Accounting standard 29, you've got a three-step procedure. Is this by chance or got to be? Just a chance. But sometimes this three-step procedure is going to be very helpful indeed. Now, look at this carefully. When I looked at the definition of provision, I said provision is liability plus estimation. The keywords gives me a mathematical equation that provision is supposed to be a liability plus an estimation. When I looked at the definition of liability, it said liability is supposed to be a present obligation arising from past events, plus there will be an outflow in order to make a settlement. So which means I can club this entire concept and start putting across three questions to myself. Now we will take around 10-15 minutes to develop the concept, and once we develop the concept, you will be able to understand the entire concept in a logical flow. So I am going to put across three questions to myself. Now, what is to be evaluated in these three questions is what we're going to learn. But at least let's learn the art of which questions am I going to put across to myself. The first question I'm going to put across is there a present obligation arising from a past event? Yes, sir. Will it result in an outflow? Yes, sir. Can you make a reliable estimation? Yes, sir. Create a provision. Trust me, in terms of creating a provision in the books of accounts, it is always a three-step procedure, and I have not created this three-step procedure. This three-step procedure is given in Accounting Standard 29 as well. If you look at, there is a flow chart which is given, which is a little early to show you, but there is a complete three-step procedure which elaborates me how to decide its a provision. So I think we've zeroed down on the three questions, but I think we need to get into a little more details on these three steps. Step number 1. Is there a present obligation arising from a past event? Don't worry. If you're thinking, so what is a present obligation? Don't worry, we'll understand. But let's understand the sequence of the question. Is there a present obligation arising from a past event? Yes, sir. Will the settlement of this present obligation result in an outflow in the future? Yes, sir. Can you make a reliable estimation of the expected outflow? Yes, sir. Please create a provision. Don't worry, I'll document these notes to you, but I think first I need to understand the inner details of these three questions. Now, hear me very carefully. As I said, there are three set of questions. One is looking at, is there a present obligation arising from a past event? Let's take an example to illustrate this concept to you. Because in order to understand, I think we need to go to an example. So let me do one thing. Why not take an example which is given, below the standard itself? So there is a small little examples which are given at the appendix of the standard, and I'm going to run through those examples with you. So once this standard gets over, at the end we are given the appendix. You can see the appendix. There is illustration A. I'm not looking at illustration A. I'm looking at illustration B. This is decision tree, which I'll come to later. I am looking at the illustration number C, the illustration 1. So I'm looking at illustration C in the appendix of AS29. Look at this example and we'll try to run through three questions in this. A manufacturer gives a warranty at the time of sale to purchaser of its product. Under the terms of the contract for sale, the manufacturer undertakes to make good by repair or replacement manufacturing defects that become apparent within 3 years from the date of sale. On past experience, it is probable, more likely than not, that there will be some claims under warranty. Now, get the connect very carefully. I said the first question is that you need to ask yourself that is there a present obligation arising from past events? There are three sub questions. Hear me very carefully. There are three sub questions within the step number 1. Is there a present obligation arising from a past event? You need to put across three sub questions to yourself. Number 1, is there a past event? Number 2, is there an obligation? And is that obligation present? Mind you, my first question was that is there a present obligation arising from a past event? I said rearrange and put three questions to yourself. Is there a past event? So what do you mean by a past event? In this example, when you made a sale, the sale will give rise to a warranty, which is an obligation. So you need to see that there is an event which triggers an obligation. You are obliged to meet a warranty. Why are you obliged to meet a warranty? Because you made a sale in the past. The sale is the past event which will trigger the obligation. Obligations under AS29 is of two types. One is what we call, it's a legal obligation, which is including contractual. The law tells me to do something. It's a legal obligation. I have entered into the contract with someone, so there is a contractual obligation. There is no other obligation. So if I am told by law to do it, or if I have entered into the contract with someone, so there is a legal obligation by law or by contract. But there is another obligation which AS29 considers to be an obligation, and that is an entity feels that it should do something. An entity feels that, in order to maintain good business practices, law doesn't tell me to do it. I am not contractually obliged, but I feel that as a good business practice, I must do it. This is technically called a constructive obligation, though this term is not used in AS29. But whenever you look at a question, you need to zero down, is it an obligation where the law is telling you to do something? Or is it an obligation where you've entered into the contract? Or is it something as a good business practice, you want to do it? It's called a constructive obligation. There is no fourth obligation. So when you see a question, you need to zero down on the fact that number 1, is there a past event, like a sale in this case, which is giving rise to an obligation, and it says under the terms of the contract for sale. Under the terms of contract for sale means what? That you are looking at a legal obligation. So is there a past event? Yes, sir. Sale. Is there an obligation? Yes, sir. By the terms of contract. Great. Is it present? Now, when you say it is present, the word present means that it is probable. It is more likely than not. The chances of occurrence is more than 50. I didn't say 50. I said more than 50. If you notice, it says very clearly it is probable that there will be some claims. He's very clearly said that it is probable that claims will be there. Now, if you connect the three inputs, is there a past event? Yes, the sale. Is there an obligation? Yes, by the terms of contract. Is it present? Yes, because it is probable. It's more likely that claims will arise. The first step is done. The first step stands done. Then we go to the next question. Then we go to the next question and we put across a second question to ourselves. Will there be an outflow to settle the present obligation in the future? When you're going to settle this present obligation in the future, would it result in an outflow? If you have to make good by repair or replacement, there will certainly be an outflow. So if you want to make good by repair or replacement, there is certainly going to be an outflow. And then you go to the step number 3. Can we make a reliable estimation? It says in the end that there will be some claims under the warranty. And let me tell you, unless mentioned otherwise in the exams, the third question is always a yes. If you are able to prove that there is a present obligation from a past event which will result in an outflow, 100% reliable estimation can be done. So this sounds a little complicated because we have done this standard earlier and we never looked at this kind of examples in the same flow. I know, but it is very important to get the concept. Unless you are able to get the concept in the right spirit, you can never attack a question. Knowledge is what I call a weapon to fight in the exam. Your knowledge is the only weapon with which you're going to fight in the exam. And if you don't have that weapon, then you are going to lose the battle on day one. And losing the battle in CA means it goes going to cost you 6 months of your life. So what is important is to get the larger concept. Okay, let's do one thing. Let's, I think, zero down on this once again. Hear me carefully. Then I think I'm going to run through some more examples to give you the larger picture. Now, let's, I think, do a little documentation along as we understand things. So, as I said, in order to create a provision, I am giving you a 3-step procedure. In order to create a provision, I am giving you a 3-step procedure. And after I've taken the 3-step procedure, we're going to run through 2-3 examples to give you the larger concept clear. So what is the 3-step procedure? And go with this 3-step religiously. Don't mix the order. There is a step number 1. There is a step number 1, and within the step number 1, there is 3 sub-steps. Number 1, you will ask yourself, is there a past event? Is there a past event? So you need to first of all ask yourself, is there a past event? Don't worry, we're going to work upon this, that what is a past event. But I just gave you that a past event means what? Which triggers the obligation. Which triggers the obligation. In every example which I'm going to go through, I'm going to go through these sequence of steps, step by step. So we have a question, is there a past event? What is a past event which triggers the obligation? We just saw one example. When you made a sale, the warranty is getting triggered because of the sale. So what is the past event? The sale. So the answer, if it is yes, you go to the substep number B. So once you are able to prove that yes, there is a past event, you go to the substep number B and you put across a question that is, is there an obligation? You put across another question, that is there an obligation? And when I said there is an obligation, in this case, I said it might be legal. The law is telling me to do it. Or there is something where you've entered into the contract, so you are contractually bound to meet the obligation. Or there is something, what I said, constructive in nature. Constructive in nature means nobody is pushing me to do it. But I feel as a good business practice, I should do it. So law is not forcing me. There is no contract where I am contractually bound, but I feel in order to maintain a good business practice, I should, meet this obligation. So if you say yes, there is an obligation as well, then you go to the sub-step number C and go step by step. Don't hurry on the concept. And then I'm going to ask, is it present? So is the obligation present? Now, when you say it is present, it means the probability of occurrence of this obligation is supposed to be more than 50. I didn't say 50. So the word present would mean that there is a probability of 50% plus. So, but then how would we assess that an obligation is probable? Either the examiner would give you straightforward and tell you that it is probable, but if it not, then the easiest way to find out whether it is probable or not is to put across, can you escape the obligation? If you cannot escape the obligation, it is probable. I said you need to put across a question, can I escape the obligation? If you cannot escape the obligation, then it is probable. If you say I can escape, so how can you escape a legal obligation? If the law tells you to do something, do you think you can escape? Don't worry. I'll give you example for that as well, where you can escape obligations in spite of the fact it is legal in nature. We're still developing the concept, so let's first go with the concept. So what do you need to do in step number 1, ABC? You need to see, is there a past event? Yes, sir. Is there an obligation, legal, contractual, or constructive? Yes, sir. Is it probable, present in nature? Yes, sir. Go to the step number 2. Go to the step number 2. Don't worry, we are going to apply this to a few practical case studies with you so that you'll be able to relate this concept the way it should be related to the practical case studies. In the step number 2, you just need to make an evaluation that will there be an outflow in the future. When you will settle this present obligation in the future, will there be an outflow? If you say yes, there will be an outflow, you just need to go to step number 3. And trust me, there is no complications in step 2 and 3. The main concept is in terms of step number 1. Now, in terms of step number 3, you need to ask yourself that can we make a reliable estimation? Can we make a reliable estimation of the outflow which is going to happen? And if you say a yes, then I will recognize a provision in the books of accounts. Sir, I think we largely understood the concept. I think you need to endorse it with some practical case studies. So I think let's do one thing. Let's take 3-4 examples with you where I'm going to exactly run through all the 3 steps with you, including the 3 sub steps in the step number 1. Oh, I think I just shorten it up. Let me increase this. So in this particular case, I think let's do one thing. Let's apply this procedure to you. And I think I'm going to make a run through on these examples. Now it's time. Hear me very carefully on these examples. We'll read the example, we'll apply these steps, and we'll get the concept. Let me go back to the illustration 1. A manufacturer gives a warranty at the time of sale to purchaser of its product Under the terms of the contract for sale, the manufacturer undertakes to make good by repair or replacement manufacturing defects which are apparent within 3 years from the date of sale. On past experience, it is probable that there will be some claims under warranty. And trust me, a lot of words are indicative of your thought process. Let's begin. In this case, we are looking at creating a provision for a warranty. Hear me very carefully, hear each and every word carefully. I am looking in terms of that there is a need to create a provision for a warranty. Now, when you're saying I want to create a provision for a warranty, I need to first see, is there a past event which is necessitating the creation of a provision? The sale. The sale is the past event which is triggering that a warranty claim may arise. So we are looking at creating a provision because the sale has already occurred. I know you're thinking, so can you give an example where the past event has not taken place? No worry. After this example, I'll give you one example on that as well. So the first thing is there a past event in this case? Yes, the sale. Number two, is there an obligation? Terms of contract. There is a contractual obligation. Great. Number three, is it present? It very clearly says on the past experience it is probable. Probable means it is present because it is more likely than not, chances are more than 50%. So step number one is met. Will there be an outflow if I meet this obligation? If you're going to make good by repair or replacement, outflow will take place. Can I make a reliable estimation? It goes without saying. If you say on the first question, Kabul hai, second question, Kabul hai, and third question, Kabul hai, you recognize a provision in the books of accounts. So now please give us an example of an situation where a past event has not taken place. Let's give you a good example. My entity entered into a contract with someone to deliver the goods on a specified dates. My company has entered into a contract to deliver goods on a specified date. I'm sitting on the balance sheet date, though the deadline of meeting the date has not yet come. But I am feeling that I may not be able to meet the deadline because there is a fixed delivery schedule, and sitting on the balance sheet date, I am apprehensive that I may not meet the delivery schedule. If I don't meet the delivery schedule, there is a penalty. When will the penalty get triggered? The penalty will get triggered when you fail to achieve the delivery schedule. Have you already failed to meet the delivery schedule? No, sir. You're only anticipating that you may not meet the delivery schedule. This is a case where a past event has not taken place. If you want to create a provision for a penalty, there has to be a failure of meeting a delivery schedule. Anticipation in terms of the fact that I may not be able to meet a delivery schedule indicates the past event has not taken place. I will not create a provision because I fail the step number 1A itself. I hope you got the picture. Let's, I think, take few more examples with you so that we can get the, three steps very clear. Look at the illustration number 2. An enterprise in the oil industry causes contamination but does not clean up because there is no legislation requiring the cleaning up. And the enterprise has been contaminating the land for several years. On the balance sheet date, it is virtually certain that a law requiring a cleaning up of the land already contaminated will be enacted shortly. I didn't tell you earlier, but I think I'm now going to tell you that if there is an obligation, either I said there is a law, or I said there is a contract, or you feel that it is to maintain a good business practice. It is not necessary that the law should always be there. Even if the law is not yet enacted, but it is virtually certain, that means beyond any doubt. You are certain without any doubt that the law will be enacted. It is as good as a law. AS 29 very clearly tells us that whether the law is already in place or the law is not yet enacted, but you need to be certain that it will be enacted, it is considered as a legal obligation. Let's apply the three steps to this question one by one. Is there a past event? What am I looking at? I am looking at a provision for cleaning up, right? The provision for cleaning up is triggered by what? You caused a contamination. That is the past event. So the contamination is the past event which triggers that you need to make a provision for cleaning up. So has the past event taken place? The contamination of the land has taken place. Is there an obligation? Legal in nature. The law is not there, but it is virtually certain it will be enacted. Number C, is the obligation present? Well, if the law is made and they will find out that you have already contaminated the land, do you think you can escape? Do you think you'll be able to escape the liability? Of course not. So there is a past event which has resulted in an obligation and it is present. Step one is met. Will there be an outflow in terms of doing cleaning up? Of course, yes. And what about the third question, that you can make a reliable estimate? Sir, of course, yes. Even if the question is silent, if you say a yes to the first two steps, the third is always a yes, at least from the examination point of view. Trust me, don't even say a no in terms of third question. So practically, we don't need to evaluate the step three. No, you don't need to. Your main concentration will go in terms of step number one. So, more example. Okay, let's give you another example. We'll take two more example. One is illustration 4 and then one more example which will, I think, clear the concept. A retail store has a policy of refunding purchase by dissatisfied customers even though there is no legal obligation to do so. Are you thinking the same thing which I am thinking? Yes, sir. Its policy of making the refund is generally known. Don't hurry up. Hurry makes a curry. So immediately your mind is telling you, oh, they have a policy of refunding. So this must something, they want good business practice. Sir, constructive obligation, let me create a provision. Don't run, don't run. Speed thrills but krills. Let's go step by step. Is there a past event? The sale is the past event. Number two, is there an obligation? Yes. The company has a policy and everybody is aware of the policy. It is something like constructive obligation to maintain a good business practice. Is it present? I don't see that I would escape such liability if people come to me and tell me, sir, I am dissatisfied with your product and I have a policy of refunding. I don't think so. I'll tell him, who are you? I'm not going to give you money back. So we don't see the possibility of escape. So it is present. Then we go to the next step. Will there be an outflow? If you're going to make a refund, there will be an outflow as well. Can you make a reliable estimation? Always a yes. So create a provision, right? So this is the way we're going to proceed. So can we do this kind of steps in the exam? Can we tell the examiner step 1 ABC, step 2 and 3? You should do it. Why not? Because in this particular case, when you are presenting the answer to the examiner, the conceptual clarity should go ahead. That's how you're going to get full marks in the question. Try an example and see if you can fit in these steps in that particular question. Let's have a look at illustration number 6. The government has introduced a number of changes to the income tax system. As a result of these changes, an enterprise in the financial service sector needs to retrain a large proportion of its administrative and sales workforce in order to ensure a continued compliance with financial services. On the balance sheet date, no retraining of the staff has taken place. Do you remember that you need to ask three questions? Because many a times you will forget that you need to put across three questions. So go step by step. At the first instance, I am thinking, is there a past event? What am I thinking? I am thinking of creating a provision for training. So, one thing which is coming to my mind is, before I even look at anything, one focus is coming to my mind. Is there an obligation of the employer to train the employees? Does your employer train you? Is he got a legal obligation? No, sir. Is he got a contractual obligation? No, sir. Somebody has got a constructive obligation. Where is it written in the question? If there is a constructive obligation, the question has to tell me that the entity, the company's management is very kind, that whenever there are changes in the, income tax or any other things, they have a habit of training employees. Am I given any facts in the question which tells me that the employer is legally, contractually obliged or constructively obliged? No. So if there is no obligation, I think I'm not even looking at anything further. There is no question of making any provision for trainings. So I'm not going to make any provisions because I don't have an obligation. Now, I think, let me first of all tell you clearly, let's, I think, go back and have a look and consolidate the inputs we have learned in terms of creating a provision. Today, we have just talked in terms of a provision. So there is more to it. We need to also discuss the interaction of a provision and a contingent liability, but not today. So you need to go through a three-step procedure in terms of deciding whether to create a provision. Has a past event taken place which triggers an obligation? The sale, for example. Is there an obligation? Legal. The law is already there, or the law is not there, but it is virtually certain it will be enacted. It is contractual. It is constructive. You go to the next one. Is the obligation present? Is it probable, more likely to occur? So which means indirectly you need to see, can you escape it? If no, it is present. If you can escape it, then it is not present. So you didn't give an example where we can escape a legal obligation. I'll give it to you right now. A company has got an aircraft which by law is to be overhauled once in every 3 years. Now, if you've got an aircraft which needs to be overhauled once in every 3 years, I am planning to sell the aircraft before 3 years end. My future actions will avoid my obligations. Did you hear me correct? You need to do the overhauling once in every 3 years, but I don't plan to keep the aircraft for 3 years. I plan to sell it before 3 years. My future actions can escape my obligations legally. It is not probable. Yes, at times you need to apply a good mind in terms of evaluation. So, what do you need to do? You will say, is there a past event? Yes. Is there an obligation? Yes. Can I escape it? No. Then step number one is met. Then you go to the step number two, which is pretty easy to answer, that if you're going to settle this obligation in the future, would there be an outflow? Generally, yes. And can you make a reliable estimation? Generally, yes. So your focus is on the first step, mainly ABC. Trust me, try applying this procedure to various questions and you're going to get a good hang on this standard. That's all for the day, friends. Thank you for listening. Take care and goodbye.